All right, everyone, welcome back to another roundup edition of On the Margin. Today, unfortunately, Mark is taking a break, but we still have a great show for you. Bit of an interesting format. For the first 30 or so minutes of the show, my colleague Jack Farley and I of Forward Guidance are going to be interviewing Yoon Lee. Yoon is a Buffett watcher extraordinaire. We had the 2022 shareholder letter come out from Berkshire, and we're going to be digging deep into that letter and what we can learn from it. The last half hour is going to be Jack and I going back on some of the more typical macro talk that we usually do on the roundup. So without further ado, we're going to get right into it. Enjoy. All right, everyone, welcome back to another episode of Forward Marginal Guidance, which is the name for Jack and my mashup here. So I'm joined by my co-host on this particular episode, Jack Farley, and we've got Yoon Lee, who's a markets reporter at CNBC. Yoon, welcome.
Thank you for having me.
Great to be here, Mike.
Yeah.
Great to be joined by Yoon. Yoon is an expert on all things Berkshire Hathaway and Warren Buffett. So we're very lucky to have her here.
Thank you so much. I'm very glad to be here.
And there's no better week, right? We just had the 2022 annual letter come out from Berkshire Hathaway. There were a couple of barbs from the Oracle from Omaha, right? He definitely had some very choice language that he included. But Yoon, you've been covering Warren Buffett and Berkshire deeply for the past couple of years. So be very curious to just kind of get your high level take on the shareholder letter.
Yeah, the annual letter, it's been a tradition for 6 decades and always interesting, always, very highly anticipated every year. And me as a reporter, it's always exciting, You log on, you download the letter at 8 a.m. sharp. Sometimes the website would crash, and then you finally get it, and then you read it quickly from top to bottom. And sometimes I would read it from bottom up just to see if there's any big news in terms of succession or retirement. Obviously, not this time. So it's very exciting, always nice to hear what his takes are on market and on the economy. I do have to know, though, the letters have been getting shorter and shorter over the years. I've heard people say, there's some disappointment and it's not as informational as they were before. And Buffett, he doesn't really like to talk about things that people want him to. And the message is kind of in the things that he doesn't address, that he omits, which is interesting. But there are still some takeaways from this year's letter. And I think the biggest headlines, one of the biggest headlines we got this year was how he really defended stock buybacks and pushing back on critics. As you said, I'm sure you read this wonderful quote in the letter, and I'm going to read it to you right now. So he goes, "When you're told that all repurchases are harmful to shareholders or to the country or particularly beneficial to CEOs, you're listening to either an economic illiterate or a silver-tongued demagogue, characters that are not mutually exclusive." So really slamming the critics there. Very interesting language. So why is he defending buybacks right now? Berkshire in 2022, in 2021, it was a record year of buybacks for Berkshire. They repurchased $27 billion in Berkshire shares. And then last year, 2022, it was much lower, about $8 billion, because Buffett found external opportunities in the market. He also did a big deal. He bought insurance company Allegheny for more than $11 billion. So he found other ways to deploy his mountain of cash. So he bought back way fewer shares. And buybacks have been under fire recently, especially among politicians. It's kind of politicized. Um, Critics, they think buying back shares, they think companies have better ways to use their cash for the long-term growth for the company. For example, you can use cash to improve employee benefits, for CapEx, upgrading your factories, your equipment, and those are better for long-term growth, as opposed to you buying back shares. You're essentially lowering the number of outstanding shares, right? Your share count goes down, so your stock price automatically gets a boost. And that might not be sustainable if you stop doing that, right? And then obviously Buffett disagrees with that. He thinks buybacks are beneficial to all shareholders because he said the math is simple. Share counts goes down, and then your interest in all different kinds of Berkshire businesses goes up. So it's beneficial to shareholders. So I thought the buybacks discussion that was something that really jumped out to me.
Right. Yeah. For Charlie Munger, Warren Buffett's partner, that type of language would be par for the course. But for Warren Buffett, that was definitely some very fiery language right there with silver
Yeah,
tongued
very sorry.
demagogues. And yeah, usually just for our audience. So when a company makes money, there are two ways it can return capital to shareholders. One is via dividends, and the other is buybacks when they buy back their own share, reducing the number of shares. So you're absolutely right that the stock price tends to go up. There's upward pressure on the stock. However, I think Warren Buffett, he focuses much more on he's all about businesses, not stocks. He's about the fundamental earning power. So, if when you buy back stocks, there are fewer shares, so the earnings per share goes up. So he's a defendant of the practice of buybacks, which he thinks is legitimate and can be good in some instances. However, tell us about the circumstances where Warren Buffett might think buybacks are bad. And I'll throw two hypotheticals at you. One is when a company buys back its own stock that is actually not undervalued, but overvalued. And the other is one in which corporate executives are keeping the stock price high so they themselves can sell, or offsetting the effect of employee share-based compensation, where a company is giving away like $500 million in its shares, and then it's buying them back. So, but it's not reducing the share count. The share count is remaining flat.
Right. Right. If an executive, if they buy back shares and you see executives immediately selling some of their stocks, that's not good, right? And we know Buffett is never going to sell any of his Berkshire stake. And also, Buffett, he has his own calculation, his own formula when it comes to buying back Berkshire shares. So he only buys back, he said when it makes sense, but he only buys back when Berkshire shares are trading 20% to its intrinsic value, right? And then he has his own calculation of intrinsic value, which is, his investment plus cash plus the value of his different businesses. He has insurance companies, energy companies, railroads, retailers, all of that. You add that up, and then you apply a reasonable multiple. Sometimes, I think typically 11 times, and then you get the intrinsic value. If it's trading 20% or more into that value, intrinsic value, he tends to buy back shares. So he really thinks about shareholders, and if it makes sense for Berkshire to buy back shares. He really looks at the stock prices. And now Berkshire hit its record high in March last year. It's above $500,000, really high. Now it's down a lot. So maybe he'll buy back more this quarter. We'll see.
And what do you think his appetite is for acquisitions? He notably was somewhat on the sidelines during 2020, and that annual meeting of 2020 really was quite stark when he was announcing, I don't know if the airlines can make it. And he sold all of his airlines at low prices. Then in 2021, there was a moment not during the letter, but during the annual meeting where he said, we're actually finding our companies can pass along prices. We're being charged more, and then we're charging more, and that was a very, very important sign for the global economy. What do you think? What do you think Buffett has cooking right now? What is he thinking? Is he as worried about a potential recession as some folks are? Or does he not think that way? He's just focusing on finding the best quality businesses. Is he seeing bargains? What do you think he's seeing? What if the letter was completely unaudited and it was just his stream of consciousness thoughts? What would that letter say?
I think he is haunting some targets right now, especially after this big sell-off we've seen last year, and asset prices have come down a lot, right? And then he's been touting this elephant-sized target for years, and people wonder, if Allegheny was that elephant-sized deal. Probably not. Only $11 billion, right? And then he also, one of the biggest moves he did last year was buying a lot of Occidental Petroleum shares. He even got approval to purchase half of the oil company, right? And Berkshire's stake is above 21% now. And I've talked to many people who think he is probably going to buy more Occidental shares. And especially now the stock is below his average purchasing price. And, he was really spot on. So the two biggest stock picks last year, Occidental and Chevron, two energy stocks. And guess what? Energy sector was the biggest winner last year. Occidental was the biggest gainer in the S&P 500, right? And then, and now we're seeing this reset, this little correction this year. So he might get more shares in the energy sector, which is a very traditional value sector. Um, and and he's doing a lot of stuff. I mean, last quarter, um, he sold a significant portion of Taiwan Semiconductor. I don't know if that stock is on your radar. He bought $4 billion of Taiwan Semi in the third quarter, but sold most of it in the fourth quarter, which is very rare for this. He's the biggest buy and hold guy, right?
Yes.
So it's rare to see him get in and out of the position, such sizable position that quickly. So he is actively trading, actively looking for bargains. Um, so that's my suspicion right there.
And do you have a sense of why he got out of Taiwan Semi? As you said, very rare for Buffett to get in and get out of things. He is the ultimate buy and hold. The ideal duration for holding a stock is forever. I think he said
Yeah.
exactly that. So for the average trader, I got into this stock, I got out of that stock. That's somewhat common. Buffett is not about that at all. He's a long-term investor. So for him to sort of buy this Taiwan semiconductor and then flip it the next quarter, it says something. Is he maybe worried about U.S.-China relations, the CHIPS Act?
Yeah, it's very rare. He said, Charlie and I, we are not stock pickers. We are business pickers. They pick longer term quality business and investing something for the long haul. It is very rare. And um, Taiwan Semi, the stake being in the $1 billion range, it's probably not from his investing managers, Ted Weschler and Todd Combs. It's probably Warren Buffett's buying. And I spoke to some of my sources, and something worth noting is that Charlie Munger did his annual meeting with Daily Journal a couple weeks ago. I don't know if you guys listened. He There was a question about semiconductor and Taiwan Semi specifically, and that gave me a little bit insight into what they were thinking about this sector. And he specifically said that it's really hard to time this sector to buy something because of the cyclical nature of the semiconductor industry. It ebbs and flows so much, and it kind of moves in tandem with the economy because it's very cyclical. So maybe they think the cycle is ending, and um, they're a little bit negative of what's ahead in terms of the economy, in terms of the sector. Um, Obviously, Buffett didn't really comment on any specific stock really in the letter, and I'm sure the question will come up in the annual meeting. So, but I wonder if that's kind of a signal of how slightly negative he is about the economy in the short run, selling out of Taiwan Semiconductor. And as you mentioned, there's also political tension between China and Taiwan. Um, I don't want to speculate there. Him buying such a big stake in Taiwan Semi was a vote of confidence back then in the third quarter. That's what people were saying. They were like, "Oh my God, Warren Buffett. Him and Charlie Munger. They have been bullish on China for the longest time." And people are saying he's not worried about any political tension buying such a stock. And now he sold it so quickly. I don't know what's going on there. If anything changed on the political front, and also Taiwan Semi, after he bought the stock, after it was revealed that he took such a big stake, the stock took off. Right, it went up by a lot of. It went up by at least 10% in the fourth quarter, and maybe he thought, we've got enough profit to take here, and of course, it went on to rally a lot more this year, which he kind of missed out on the biggest rebound there. But that's another story. So that's some of the reasons that I can think of him
Right.
selling that stake.
Thanks. And is there any whisperings of Berkshire Hathaway buying any Chinese equities? Warren Buffett, as in the past, he bought a large stake in PetroChina early 2000s that turned out fantastically. I mean, Charlie Munger he loves China, and some of his private wealth is invest a lot of his private wealth is invested in there. I mean, he's spoken saying Jack Ma shouldn't have said what he said. So yeah, so it's and Chinese equities have been from where they were a year or two ago very depressed, and they're valuation people. So uh, might they be interested in getting into China? And if not, what does that say?
Yeah, I think over the years, recent years, his appetite for international stocks has gone up, has gotten bigger. He bought into 5 Japanese trading companies, either last year or the year before. I don't really remember, but it was a really big stake. And combined, they were among the top 10 holdings of Berkshire. And he revealed last year they bought a couple German companies. We still don't know what they are, but he said they bought some German securities too. And Berkshire was an early investor in BYD, the Chinese electric vehicle company, and Charlie Munger bought BYD because under the influence of his friend Li Lu, who is a asset manager here, I think based in Seattle. And they've been very good friends over the years. And Li Lu is the only person who's managed Charlie Munger's personal wealth other than himself. Okay, and then he introduced him to Alibaba, to Pinduoduo, other Chinese stocks. So and BYD has done exceptionally well over the years. And I think Berkshire's stake has gone up by like 600%, something crazy. And Berkshire this last year has been trimming that stake, kind of ringing the bell on the bet a little bit, taking some profit. But I wouldn't be surprised if he bought more Chinese stocks or international stocks in general.
Hello, everyone. Thank you all for listening to On the Margin. Just wanted to give you guys a heads up about a conference that we have coming up in the new year called Permissionless. I'm sure most of you have been there last year. It is the cultural event of the year. We had over 5,500 people down in Palm Beach. This year, we are moving to Austin, Texas. You know what they say about Texas? Everything's bigger in Texas. So last year we had a really great lineup of speakers. We had the 2 co-founders of Robinhood, Vlad Tenev and Baiju Bot. We had Chris Dixon. We had some of the folks that have been on the show a whole bunch of times, Jim Bianco, Dan Tapiero. Just a phenomenal lineup of speakers, and you can expect the same this year. If you use Margin 10, you will get 10% off on a ticket. Again, that's Margin 10, because I love you guys so much. Click the link at the bottom of the show notes. Hope to see you there in person. One part that stood out to me, and you and I definitely don't track these annual letters as deeply as you do, but there was he dedicated about a page or so to some surprising facts about federal taxes. So he starts off this is the quote from the letter: during the decade ending in 2021, the United States Treasury received about 32.3 trillion in taxes, while it spent 43.9 trillion. So that's about a $10 trillion deficit or so over the last decade. I'm curious, what did you kind of take away? Is that sort of a typical digression for Buffett? What do you think he really meant by this kind of passage? And, how do you interpret him including that statistic in this letter?
I think taxes in general is a hot button issue for billionaires like Warren Buffett, right? And then
Yeah.
so I think he wanted to address some of it. And I think the main takeaway I got from that section of the letter is that he said how he's happy, he's glad to pay taxes because Berkshire has benefited from the American tailwind, as he put it, and that's kind of him reaffirming that he is still a believer in the country.
Mm.
And especially last year. And then that's a message he's been conveying to shareholders years after years, right? Bet on America, never bet against it. Even during the pandemic, at the height of COVID, his really key message to investors was that never bet against America because the country always prevails. We've been through wars, we've been through natural disasters, political chaos. We always prevail, we always survive. And I think that portion of the letter is that's my takeaway from that portion of the letter. Just he wants to say that I'm happy to pay my taxes. I'm betting on America. I'm benefiting from America, from capitalism, and that's what I have to say about it about taxes. I think that's my takeaway.
Yeah, absolutely. I think he started off this shareholder letter sort of thanking right the his sort of LPs in a sense for Berkshire Hathaway, the people whose money he is managing, on behalf of, and that is who he says he has in mind when he's writing this letter. However,
Mhm.
when you kind of look at his thoughts on stock buybacks, right, and that particular Barb, a silver-tongued demagogue,
Yeah.
there's a very limited number of people that could potentially refer to. And I look at
Right.
his description of taxes. A part of me thinks, hey, this is actually a very savvy guy, and he understands that it's a much broader base of readers than just the shareholders of Berkshire Hathaway. So,
Mhm.
I know this is kind of a broad question, but like, what's your kind of take, having read a lot of these letters? Like, who is Buffett really talking to with his audience? Like, what is the point of him kind of opining on taxes and buybacks and all that stuff? Who is he trying to reach with that message?
Yeah, he generally doesn't like to comment directly on political issues, but
Mm,
the letters, especially during annual meetings, but the letters, it is a way for him to say things in his own way, to control the narrative, so to speak. And I think, as you said, he addressed the letter sort of to his business owners and shareholders, but he also include some political issues, some issues that have been politicized, like taxes and buybacks. So he's definitely talking to his critics, the naysayers, right? Not only to his admirers around the world. And yeah, so I'm trying to think what other political issues he kind of addressed in the letter. Nothing really came to mind. So I think buybacks is the biggest hot button issue there that he really addressed this time. We were all very surprised by the language he used.
mm,
Mm. Yeah, I've got a question, which is people have a characterizations about what level of interest rates or in what direction they're going in are good for some companies. So an unprofitable technology stock, rising interest rates are really bad for them, but a bank, they're really good for them. What is your sense of how rising interest rates affects Berkshire Hathaway? Because their insurance business takes in a ton of cash and they have, hundreds of billions of dollars in treasury bills, which 2 years ago yielded nothing and now yield, close to 5%. Is that a good thing for Berkshire? A bad thing for Berkshire?
It's kind of a combination, and that's something that people really wanted to hear him talk about inflation, not inflation, interest rates, but he didn't. But I'm sure he will during the annual meeting. But interest rates are very important to investing, to asset prices. I think he said very famously a couple of years ago. He said interest rates to asset prices is like gravity to the apple, right? Gravity to the matter. So there's really this gravitational pull on asset prices when interest rates are higher. And now, so two things. Interest rates, as you said, short-term treasury yields, some of them are yielding 5% right now. And Berkshire Hathaway having so much cash, I think about $130 billion at the end of last year, and the majority of it investing in treasury bills, they are making very substantial return just by investing in risk-free short-term treasuries, right? Billions of dollars. And and also, there's another aspect, which is that higher interest rates give Berkshire an advantage when it comes to deal making.
Mm,
Buffett and Berkshire, they didn't pull the trigger for the longest time there because the competition was getting really tough. They were competing with SPACs, they were competing with private equity, And because those people, they're borrowing money for free. Interest rates were zero. And now interest rates are much higher. And Berkshire Hathaway have so much cash that they can tap into, so much liquidity. They can, it really gives them an advantage when they go to, negotiate for deals, because his competition, private equities and others, they might have a hard time because they need to pay such high interest when it
That,
comes to making deals.
that's such a good
And
point. I didn't
also,
think of that. Yeah. Sorry, go ahead.
yeah, and also Berkshire has a myriad of different businesses, from more capital intensive ones like railroads, um, energy, to retailers and insurance companies, and then they employ so much employees. Wage inflation, as we know, is very sticky right now. And inflation, it is taking a toll on Berkshire Hathaway's different operating businesses. And I think, but it's operating businesses. Last quarter, it fell a little bit, 8% compared to a year ago, because of the hit it took from inflation and higher interest rates.
Mm, thanks. Yeah, just on the car insurance front, I know
Mhm.
that there was a time Geico made a lot of money from the float, and that was a source of negative capital. Really, they can get capital at negative rates. But they might have lost a little bit of money, might not have done as well as folks like Progressive, and because they use things like telematics, which I don't really understand, but it's technology to see, oh, this person is going too hard on the gas pedal, so we're going to increase their rates. And they were late to that. Do you have a sense of their plan to get back into the business? And Ajit Jain, who runs their insurance operations, remarkable track record. But is he up to date on telematics, which is kind of like a newer thing? He's closer in age to Bucks, that
Yeah,
demographic. Yeah.
it's a really good question. Geico has been really underperforming, especially compared to Progressive. Like you said, they are late. They didn't really do the telematics. I don't really understand what it is either, but I know they've been posting a full year of underwriting losses. And Buffett said in the letter this year they're expecting a profit in the full year of 2023. So there might be a turnaround going forward. And another thing to note is that Geico CEO is Ted Combs, who's also one of Buffett's investing lieutenants. So he not only runs Geico, he also manages a portion of Berkshire's equity portfolio. And when he took the CEO position, Berkshire, he signaled that it would be a temporary position. He will be finding a replacement for him because of the big responsibility he has across Berkshire's different aspects. So people are wondering if they are going to find a replacement CEO for Geico soon. So that's a question that I'm sure will come up during the annual meeting.
Interesting. My final question for you about Berkshire is: so no one knows what the big Whopper is going to be, or if there is going to be no big Whopper. Only really Warren Buffett, Charlie Munger. But I'm sure there might be rumors of, oh, it could be this, it could be that. What are the sort of whisperings about what the prize that Warren Buffett might be eyeing for the next big acquisition?
So, yeah, there were always rumors about Warren Buffett's next deal, right? And I'm not sure if you know that there were some companies that tracks plane activities. So they would track, which company executives they fly into Omaha. What does that mean? And I think 2 years ago or last year, they saw Hershey's jet landing in Omaha. I'm sure it is all speculation, it is all rumors, but I just thought that was interesting. And Hershey, when you think about it, it makes sense, right? Buffett, he likes a big consumer, well-known brand, kind
He
of
likes
like,
candy.
Yeah.
yeah, candy, like Kraft Heinz, Coca-Cola, that type of stuff. So, yeah, that's interesting. Hershey is one. And then, him buying Occidental outright is not off the table. He can still do that. And he has been acquiring more and more. Now is more than 20% of the company. And so there's another interesting fact. So if he does take over Occidental, he would have come full circle, because the first stock he ever bought was Citi's Service preferred stock at the age of 11. And 40 years later, Citi's Service was acquired by Occidental. And
Wow.
Occidental's now CEO, Vicky Hollub, used to work at Citi's Service. So it would be crazy if that happened. Yeah.
That's fate. That's wild. And what did City Service do? Like in the oil field sector, or something
Yeah,
completely?
it's energy. It's refiner.
Gotcha. Wow,
Yeah.
interesting.
It was one of my, not too many takeaways here, but I did love the section where he kind of reminisced about buying Berkshire Hathaway. And, one of my favorite stories about just Berkshire and Buffett in general is that Buffett calls buying Berkshire Hathaway the dumbest stock or the biggest mistake that he ever made, and has actually estimated that purchase cost him about $200 billion in terms of
Wow.
opportunity cost, which is just a funny little, obviously I think that's a little bit lighthearted, but it's just a
Yeah.
funny, kind of look at history.
And Buffett, he sometimes he would admit that he's made mistakes in the past, right? And he said when he bought precision car parts, he said that was a big mistake. That was way more than what he paid for Allegheny, and he said he overpaid that, right? And then also famously when Berkshire bought, so one of the investing managers bought Amazon a couple years ago. People were shocked. Oh my God, you're a value guy, you're buying Amazon. And who would have thought today 40% of his portfolio is Apple, right? And so at that time he said, oh, I really missed out on Google. That was one of the biggest mistakes that he made, just because they had some insight into Google because how much advertising money Geico was paying. He was like, we had this insight, but we didn't really see the potential there. So he and Charlie Munger repeatedly have said that they've missed out on a lot of technology companies that they really didn't really understand. But with the help of the younger guys, younger managers, they're able to uh, increase their exposure to the technology and take advantage of the growth, especially the last bull market. It really only benefited growth stocks, right? The FANG type of things, the FANG stocks, combined, they took over 20% of the stock market. And even though Warren Buffett got into Apple kind of late, but he still made so much money out of that single stock. Um, yeah,
Right, and Apple bought back its own shares, and then Berkshire
right.
bought back its own shares, so you get the double
Yeah,
compounding effect. Yeah, that's one lesson I learned from Warren Buffett is when he says, "Oh, I don't understand Google," he's read the annual report from Google 10 times. Like he understands
yeah,
it better than most people, probably. Most people who own the stock of Google. But he just has such a high standard for understanding that you should have excess humility, and just because you can talk about it doesn't mean that you actually understand it. And I
right.
think that's a good lesson.
Yeah, and then I think when he buys something, he has to understand the whole industry. He has to understand the whole ecosystem and how the competition will shake out in the next decade or 20 years. And I think when he said he made a mistake not buying Google, he didn't really understand how of a monopoly it would be. He even said that he wasn't sure that if the search engine will have more competition. And right now it's a really popular issue, right? With different types of search engines coming up. And I thought that was interesting that he thought many, many years ago, I don't know if this Google thing, if Bing would take off, if other things would take off. Yeah.
Yeah, and I think a lot of Warren Buffett's a lot of those returns are just from not selling. Like I'm sure there are people who bought Apple in 1995 and made 200% of it, and were like, "Wow, I'm such a good investor." But literally, they know they could have made so much more if they just held. And I think to have that confidence to hold, you do have to really understand that. Um,
Yeah. And Berkshire Hathaway itself, their Class A shares, they don't do stock splits, right? So if you look at the stock price, it's like almost $500,000. And and I think Buffett said in the past that people can use Berkshire shares as a savings account. You just buy and hold for your lifetime, and your money, your what you put into it will compound. It will make you money, and I think that's also why it comes back to the buyback issue, because he believes that his shareholders are long-term shareholders and they're not going to sell um, after he buys back stocks. And so I think that kind of speaks to the buyback thing too.
Yeah, absolutely. Well, Yoon, you've been super generous with your time here, and it's great to get such a Buffett expert on the show so you could enlighten Jack and my's understanding of the letter. But this was certainly a lot of fun, and we'll have to do it again sometime soon.
Yeah, happy to do it again, and I really enjoyed the conversation. And yeah, hope to join you guys again. Thanks for having me.
Would love that,
Excellent.
Yoon, and people can find your work on CNBC. And on Twitter, you are at Yoon Lee 626. Thanks again, Yoon.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. Howdy, partner. That was a ton of fun. Yoon is great.
Yeah, oh my gosh, she knows so much, and it was great to get her here.
Yeah, 100%. Really enjoyed. I thought her knowledge of just Berkshire's portfolio over the years was super. It added a lot of great color to the shareholder letter. Where I, kind of with my untrained eye, was very focused on the buybacks and the taxes sort of part of it, but her kind of helpful context about the portfolio was just excellent.
Right, and we've been focusing so much on Berkshire. I think we've kind of been neglecting the macro. So we need to talk about the Federal Reserve. We need to talk about inflation. So let's get into it. So all the macro heads are like, this is great, but where's my, where's my content?
You are absolutely right, Jack. You are absolutely right. All right. So I want to start, Jack, just talking about rates here. So what we're looking at here is the market pricing for the U.S. terminal rate, and that is creeping up to just under 5.5%. And the reason for this is the PECE numbers that came in earlier this week. Those came in much hotter than expected. We've got some charts on those later. But again here, so the bond market just responding just as you think it might, right? So we've got the 2-year and the 10-year over here to the left, both of which are shooting up. But of course, we've got, it's very inverted across the entire duration of the curve. So we've got the 2-year yield just clocking at 4.92%. And the 10-year yield, oops, I got the wrong chart there, but that's at just over 4%. So there's almost an entire percentage point, so 100 basis points of inversion there. What's your kind of take here? I mean, just kind of zooming out from we've got kind of a climbing terminal rate, we've got a increasingly steepening yield curve, both of which are sort of bearish signs for stocks in the economy overall. I know a couple of your recent interviews have been focused on kind of this no landing, soft landing, hard landing. What are your sort of thoughts on this?
Right. Well, I think the low unemployment rate just really gives the Federal Reserve a lot of room to cut. I was surprised by these, somewhat dovish meeting on February 1st. However, my view that the rate cuts would be priced out of 2023 has, over the past few weeks, been validated. And if you could actually go back to the prior chart that shows on the bottom right the two yield curves. So the red is the yield curve right now, and the thinner gray line below it is the yield curve on the first day of this year, January 1st. And even though the peak of the mountain look like they are the same point, about the 6 or 7 month thing, 2 months have passed since then. So that means that actually the actual pivot that was priced in January just keeps on getting pushed out and pushed out. And Mike, I remember talking with you about this and Joseph Wang about this in March of literally a year ago, when we're saying, wow, the rate hikes, the rate cuts that are priced into September are being pushed out. Like, is it possible that the pivot won't happen until November 2022? And
Mm.
now, like, we're talking about 2024, 2025. So it's just, I mean, the dominoes keep on falling, and the Fed pivots just keeps on, being priced out, and so far being proven wrong. And I just did an interesting interview with Alfonso Pecatiello that will come out on March 6th, and he's really in the buy bonds camp, and he made a really compelling case. He's not loading up the truck, but he wants to sort of move into the position. I think that will be a good trade. I'm going to do the classic hack move where you're like, I'm first going to do this, and then I'm going to do that. So either way, you get to you can't be proven wrong. But I think honestly, this sell off in bonds could continue, and I actually think you're kind of having, we could be at the start of a true fire sale in duration, and not just bonds but equities. Like, one stock that I track, it's a stock that won't have any revenue until 2026, so it's the ultimate like long duration thing, and these stocks are falling apart. So yeah, the whole transitory Goldilocks thing, it was very transitory.
Look, I think I respect that opinion. For me, it's a little bit difficult because on the one hand, it's very easy to sort of look at what's happening with yields, especially on the shorter end of the curve. You always hate to see, we've got kind of a bear steepener situation going on here. It looks very bearish. On the other hand, what we have seen over on the other half of the globe, right, is, China opening up. And it's hard to understate just exactly how important that is. My co-host, my regular co-host for this portion of the show, Mark Yusko, has kind of stated time and time again the role that China actually had in getting the world out of basically the great financial crisis, the record amounts of liquidity that they were injecting. So I think what makes this particular moment in time very difficult to parse out is that we tend to think of things as very US-centric story. And I think that's probably directionally the correct view. The Fed certainly is sitting in the driver's seat, but certainly there's something to pay attention to going on over in Japan with the sort of change of the guard in the BOJ. And then we also have to look at what's going on in the situation with China over the PBOC. So it's tougher for me to parse. If you're a regular listener of the show, I feel like a bit of a broken record. I've been saying this for the past month or so. I think there are these very conflicting drivers, and it's tough for me to figure out kind of where we're going to go from here. But I think the one thing that is clear is you're absolutely right, Jack, that the expectation of a pivot has continuously getting pushed out. This is the market pricing for Fed rate cuts in the second half of 23. And what you're basically seeing is that that's approaching zero, which means the market is no longer pricing in rate cuts in 2023 at all. And that is certainly headwinds for duration. So that's long bonds, and it's tech stocks and crypto for that matter.
Right. And yeah, I struggle to see an environment in which bonds perform where the Federal Reserve is still hiking. Like, because if the Federal Reserve is still hiking 25 basis points every 6 weeks, and you're telling me that the 10-year Treasury is going to go down in yield, that means we're headed for like a biblical inversion, which of course can happen. But to me, it seems unlikely. Maybe the 10-year Treasury sells off less in yield than the short-term rates. I don't know. But yeah, I think the yield curve is still it's still very inverted. It's like 88 basis points inverted, because even though as those long end rates have moved up a lot, the short end rates have moved up even higher. So
right.
Yeah, I really don't know. And I also say on China, I think that we're used to thinking about a recession as like a 2008 moment where the correlation goes to 1. Like every stock is just crashing, oil is crashing, copper price is going, everything is crashing, and that was the case. That's not a typical recession. That happened because like the global financial system failed, because there was tons of toxic assets that basically the US sent all around the world, that caused a global crisis. I think this recession, I don't know. I think it could be one in which the price of copper is at $4 because China is reopening vigorously, and the price of oil could be high. A lot of people say, jet fuel demand in China is only like 3% of their actual oil demand, so it's really a drop in the bucket. But still, reopening could be bullish for oil. So, and also, I was talking about this with Alf. Like, let's say Alf says in May or June, that's when the recession will start. But okay, the recession declared about the great financial crisis by the National Bureau of Economic Research started in December 2007. And in July, what is that? 8 months later, after that, after the official recession started, the price of oil was at $140. So it's not like, oh my God, everything is going to crash at once. So, it could be the case that a recession starts in June of this year, and in February of 2024, the price of oil spikes. So it's the time horizon is so key here. I know I'm just rambling, but
No, it's a really excellent point. Maybe we could rewind a little bit. We kind of started with what was happening within the bond market, but let's talk a little bit about the catalyst that sort of caused this. So we're looking at PCE inflation month over month, and that print came in hot. And we've got a sort of headline PCE. So the survey was 0.5%, and actually what in the actual was 0.6. But really, the more important thing is to look at core PCE, and that's a metric that we know that the Fed tracks very, very closely. And that's the metric that came in. The survey was for 0.4%. And it came in at 0.6. So that was kind of what came in hot. And if you're following along via video here, what we're looking at is kind of the contributions, right? And some of the subcomponent contributors to PCE on a month over month percentage. So you can see headline, you can see core. And again, it's that blue bar over on the left that we're looking at, which is services, which has kind of been persistently sticky. And again, there's a lighter blue section, which is non-durable goods. And that's been a drag on inflation for the last couple of months. And that reversed this past month. Anything else kind of jump out at you, Jack? And additionally, what do you think is kind of causing this? Because I know you were certainly surprised, you might even say a little bit critical of Chairman Powell's performance during the last FOMC. So I'd be curious, what do you think is reigniting this? And could you sort of put some of the blame on kind of the dovish stance that the chairman took during the last FOMC?
Well, I'd say I definitely was surprised on February 1st. I thought he'd come out and smash the stock market and credit spreads would blow out. So I would say I'm much more critical of myself for being wrong than I am of Powell. I think that rate hikes are a very delayed way of fighting inflation. I like to use a framework that's not my own. Zoltan Pozsar, Perry Merlin, there are four prices of money. Interest rates, foreign exchange, like dollar versus euro versus the yen, par. So like $100 in my bank account is the same as $100 in another bank account, and that's a problem when with like Lehman Brothers, stuff like that. That's related to credit. And then the fourth is the price level. How much do things cost? The Federal Reserve has a decent amount of control over the first three levels if it wants to. Now, if it wants to, you don't really have a free market, and there are lots of side effects. But if it wants to, it really can. But inflation, I mean, look, if a butcher is going to raise the price of beef from $15 to $20, Jay Powell has no control over that, and he knows that, and he said that. So I think you can't say, oh, the reason inflation has reaccelerated is because of the dovish talk. I think it's inflation affects the rate hikes much more than the rate hikes affects the inflation. I think that the Fed's going to have to be a little bit more tough. And I think why has the economy proved resilient? I think that a lot of the rate hikes were kind of the exposure to interest rate hikes has been delayed. So like tons of people borrowed money at 2.9% to buy a house in 2020 and 2021. And now that interest rates are at 7%, and you say, oh, the cost has gone up 50% to the monthly payments. But no one's buying a house now because they're not stupid. And people who had locked it in at 30 years, they're good. Like they're going to retire, and then interest rates could be at 20% or 0%. Who knows? Now, obviously, if you have no one buying a house and refinancing activity falling off a cliff, the mortgage broker industry is in shambles. That's not a sustainable model for the global economy. But the unemployment rate is at 3.4%. I recently spoke with Mike Green. He thinks that's even more lagging than normal because folks who were laid off from very high paying jobs in technology might not be as in a hurry to go on unemployment benefits, so it wouldn't be cut off.
I had a question for you about that. Sorry, I don't mean to interrupt you. I listened to that. I listened to that interview that you did with Mike, and obviously big fan of Mike. He's been on the margin a couple of times as well. But that line of logic I completely follow. The severance packages at big tech companies like the Salesforces or the Googles or the Microsofts of the world, it's like 6 months entirely paid benefits, right? So what's the incentive to go to kind of the unemployment line? The question that I have though is how much is that really impacting the overall unemployment data, because there's that kind of statistic floating out there that if basically everyone in the entire technology space, so that's like internet search, it's SaaS, it's all of those kind of high growth tech areas, it would only impact the overall unemployment rate by like 25 basis points, right? It's a very, very small number. So
Yes.
I heard and followed Mike's logic there, but I also had a question of, how typical is the Google experience here in terms of, and how much is that really moving the needle on the overall unemployment rate?
So I think the answer is not at all. And it's, in terms of the unemployment rate, it's not at all. It's tech workers is something like 4% of the labor force, but in terms of earnings, they are a lot more. So that could be another shoe to drop. Yeah, I mean, the economy so far has proven resilient, and the unemployment's low, people can afford to pay off their debts. Companies will lend them money, and now that interest is higher, they're like, I'll lend you as much money as I want. It's like people are sending everyone credit cards. It's like the Sorcerer's Stone movie, like where the letters go through the house. um, I thought
that was a great visual. I appreciate that.
And look, does this end well? Like, no, but it's all about timing. So yeah, I think the American economy a little bit less sensitive in the short term to interest rate hikes than many people thought. Maybe myself included. Amazon is borrowing money at 40 years. Now commercial real estate, refinancing offices, home builders, they have to roll over these paper, and they're having a lot of problems. They can't afford it. Some private equity firms that they're not going bankrupt, to be clear, but they have funds that own assets that are defaulting. And that can be a strategic move. Like, it doesn't mean that the entire fund is in problem, but it's not good. It's not good, but it's just a question of time horizon. If you want to ask me my base case, I think the 10-year Treasury remains over 4%, or maybe even goes to 4.2%, 4.3% over the next 3 months. I think the ultimate doom and gloom recession call probably will happen, but I think that I'm just looking at these rate hikes, and I don't know. I think once the rate hike gets priced in, it's pretty hard to price it out. The Federal Reserve tends to follow through, so we'll see. I don't know, but that's just my bias. What do I know?
I mean, what do any of us know at the end of the day? But it's just you also make this point to me quite a bit. If you want to score the bond market in terms of their predictive prowess over the course of the last 2 years, not doing so hot, right? They completely missed the inflection point in 2021, even when Powell signaled very aggressively, right, that they were going to start fighting inflation and hiking rates. I can't remember exactly what the verbiage was, but the bond market was pretty significantly off. And
asleep at the wheel, yes.
It was asleep at the wheel, yeah. And it seems to me anecdotally, but also looking at the data and just keeping a relatively close eye on this, that there is a desire in the broader market for the Fed to pivot, right? People are kind of screaming uncle. They're used to the Fed responding when they scream uncle, and that's what they're not getting. So you kind of see this like stubborn climb in terms of that terminal rate, and it just steadily has grown, higher and higher. It's I guess it's just a bit of a surprise to me, frankly, that the economy has proven able to withstand this amount of rate hikes. But the point we actually brought this up on last week's roundup with Mark. I think something that we got a little bit wrong, and I say we, I mean some of the topics that Mark and I chose to cover a month or so ago, and you see this a lot on Twitter, is kind of this skyrocketing. It's like a lower savings rate. The savings rate has kind of fallen off a cliff. And then you're also looking at booming sort of credit card debts. But what I think you have to look at in addition there is, what is the total amount of household wealth, right? And what percentage of that wealth does the credit card debt account to? And the honest truth is that after the pandemic, whether it's transfer payments or the wealth effect or whatever it was, the American consumer and the average household is actually in a far better position than they were a couple of years ago. And if you kind of remove a lot of the statistics that we're talking about, specific rates or whatever, the Fed is trying to choke off demand, right? That is what they have in their control. Historically, they've done that through the price of money and the quantity of money. So obviously, they're really trying to turn the dial on the price of money to the point where they see, a persistent drop in demand. And they're kind of getting their wish, and they're kind of not getting their wish at the same time. We've certainly seen fall off in things like ISM and PMI, right? Like manufacturing activity has responded exactly the way that you would think. But what has been stubbornly more persistent is retail sales.
Mhm.
And maybe that's because for the last 2 years, the Fed has been wanting and incentivizing the American consumer to spend. And it's harder to just rip that back all at once. Maybe it's a result of transfer payments and people have more money than they had before. Maybe it's a result of the wealth effect and prices still have not reverted. Financial asset prices, whether it's your home, which is probably the largest component, but even stocks are still above their pre-pandemic levels and maybe people still feel wealthy. Whatever it is, I think it's the American consumer that has been consistently resilient. And I mean, it's a little doom and gloom to say that the Fed wants to break the American consumer, but I think that's what they have to do in order to achieve their stated objective. So I don't know how long we have to wait for that.
Right. And the savings rate going from like 20% going down to 2%, that looks like a really bearish chart. And I understand why people think that. But when people aren't saving money and 99% of their money is they're spending it, that means that other people, other companies, and the people who work at those companies are receiving that money. So it's like it can be a virtuous circle. Like I bet in the Great Depression, the savings rate was pretty high. You know, like in China,
It is.
It's famously China. The savings rate is very high, and that's actually a problem because you know the consumer is not spending enough money, so you know they have to get orders from all around the world for exports as opposed to having a domestic consumption economy. And you know China is views that as a very serious problem.
All right, folks, and I think that's all the time we have today. So big thanks to Yoon Lee for joining us and my colleague Jack Farley. Jack, it's always a ton of fun to do an episode of Forward Marginal Guidance. Mark, we missed you this week, but we'll see you here same time next week. Thanks for listening, everyone.